Hey everyone, welcome back to Corporate Decoder. Today, FSBC just filed an 8K announcing a stock offering, and I am seeing a few interesting details about their growth plans. Quick note, this is not financial advice, just my take on public filings for educational purposes. They're selling a lot of stock, which means new money is coming in, but it also means more shares out there. So what is happening here is that Star Bancorp, or FSBC as their stock symbol, is selling a bunch of their shares to the public. They're calling it an offering, and it is a pretty big deal for them. They're aiming to sell over 2.7 million shares, and the price is set at $44 per share. This means they're expecting to bring in a good chunk of change, like over $112 million after all the fees and expenses. Now, why are they doing this? They say they want to use this money for general company stuff and to help them grow. This includes putting more money into their bank, Star Bank, to help it expand, and also for their regular business operations, what they call working capital. It is a pretty standard reason for a company to raise money, especially if they're looking to get bigger. This whole deal is being handled by a group of underwriters led by a company called Keefe, Bruyette and Woods. They're basically the middlemen who help sell the shares to investors. The agreement they signed is pretty standard for these kinds of deals. It includes promises from Star Bancorp conditions that need to be met for the sale to go through, and what happens if something goes wrong with the deal. These agreements are made for the benefit of the parties involved, and you can't really rely on the promises in them as absolute facts about the company's current state. One interesting detail here is that the underwriters have a 30-day option to buy even more shares. This is called an over-allotment option. It is like if they think they can easily sell all the initial shares, they have the right to buy a little more from the company at the same price to meet that extra demand. It shows they're confident in selling this offering. They also put out a couple of press releases. One announced they were starting this offering, and another one announced that they had actually priced it, meaning they set the final price. You can find those releases attached to this filing. Now, like most companies do, they've included a standard note about forward-looking statements. Basically, they're saying that anything in this report that talks about the future, like their plans or expectations, is just that, expectations. These things are based on what they think will happen, but actual results could be very different because of all sorts of risks and uncertainties that they can't always predict. They're telling investors not to put too much faith in these future predictions because things can change fast. Looking at the bigger picture, Star Bancorp is a regional bank. They have about 233 employees and a market cap of around $1 billion. Their stock price has been trading in a pretty healthy range over the last year, which is good to see before they go out and try to raise more money. This offering is happening at a time when the company is reportedly looking to grow its branches. I saw a headline mentioning they have 10 branches in California, and this infusion of cash will likely fuel that expansion. It makes sense, they want to grow, they need capital, and they're getting it by selling more stock. The news about pricing this offering at around $113.6 million also aligns with the numbers we're seeing in this filing. Big institutional investors like T. Rowe Price and BlackRock already hold significant stakes, which generally adds confidence to these kinds of offerings. So, what is my take on this? Star Bancorp is clearly in a growth phase. They're taking a move that many companies do when they need capital to expand, which is to sell more shares. This dilution is a trade-off for potential future growth. The question is whether they can effectively use this capital to generate returns that will make existing shareholders better off in the long run, despite the increased share count. The risk I am watching is whether the bank can deploy this capital effectively to generate a higher return on equity than the cost of equity, especially with rising interest rates and a competitive banking landscape. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hit like and subscribe. Check the Discord in the description.